Hey there. Welcome back to our home buying and home refinancing series. Today's topic is something that, can truly make or break your financial future: the FICO score. Now, if you're gearing up to buy a home, refinance, or even just to, open a new line of credit, understanding your FICO score is absolutely critical. So I'm going to explain what a FICO score is, why it matters so much to your mortgage, and how it's calculated, and the steps you can take to boost your score even before you step foot into a lender's office. By the end of this, you'll feel a lot more confident about navigating the mortgage world, and you might just save, a pile of money too. So do you ever wonder why a 3-digit number can practically make lenders treat you like royalty? Or, like you're one kid that nobody wants on their dodgeball team? Well, today we're going behind the scenes of that mysterious number, the FICO score. What exactly is a FICO score? So the FICO score is a 3-digit number ranging generally from 300 to 850 that predicts how likely you are to repay a loan on time. The higher the score, the less risky you appear to lenders. FICO stands for the Fair Isaac Corporation, the company that created this scoring model and effectively standardized credit scoring in the United States. So when you apply for a mortgage, most lenders pull your FICO score from 3 major credit bureaus: Equifax, Experian, and TransUnion. In the mortgage world, lenders usually use the middle score for underwriting, meaning if you have, say, a 690, a 700, and a 710 across the 3 bureaus, they'll often treat your application based on that 700 number. Here's a quick note about other scores. You might see references to Vantage scores or free educational scores on various apps and websites. Now, keep in mind, these scores can sometimes differ significantly from your official mortgage FICO score. Banks and mortgage companies almost always rely on a variation of the FICO model, often the FICO score 2, 4, or 5, which are then used to decide if and how much they'll lend you in finances. Fun fact, you can be rocking a 780 on a random credit app, but if your lender checks an older FICO model and you come up 20 points short, suddenly that dream mortgage rate might slip through your fingers a little bit more. Why do lenders care so much about FICO? Well, here's the short answer. It's fast and efficient way to gauge risk. Mortgage lenders have thousands of applicants, and they need a consistent, objective method to figure out who's most likely to repay a loan without defaulting. The FICO score isn't perfect, but it's widely accepted. A high FICO score is around 760 or more typically means you'll get the best interest rates and the easiest loan terms. A mid-range score, which is around 680 to 759, you might still secure a decent rate, but you may see slightly higher fees or a little more scrutiny from the underwriters. A lower score, less than 680, you can absolutely still get a mortgage, especially FHA loans or other government-backed programs. But you'll likely face just a little bit higher interest rate and stricter requirements for underwriting. Sometimes you'll need more documentation or a larger down payment. Now, keep in mind, a difference of even 20 to 30 points in your credit score can swing your mortgage rate by 0.125 to 0.25% or more, which translates into thousands or sometimes tens of thousands of dollars over the life of a 30-year loan. Now, the 5 major factors that make up your FICO score are pretty important. Your FICO score isn't just pulled out of thin air. It's calculated using these 5 primary components. Number 1, the payment history. It's about 35%. It's your biggest factor. Simply put, do you pay your bills on time? Late or missed payments can drop your score like a rock. Even a single 30-day late payment can knock points off your score and stay on your credit report for years. Mortgage lenders especially look at any mortgage or rental late payments in the past year. Those can be big red flags. The amount owed or credit utilization is about 30% of your score. How much of your available credit are you using? If you have a total credit limit of $10,000 and you're carrying a $5,000 balance, that's a 50% credit utilization rate. Experts usually recommend keeping this ratio below 30%. And if you really want a gold star, try to keep it under 10%. High utilization can signal that you're stretched thin financially, making lenders a little nervous. There's then length of credit history. It's about 15% of your score. How long have you had your credit accounts and how long have they been opened? The longer the history, the better. This factor rewards consistency and longevity. So think twice before closing that old credit card that you never use. It might be helping to keep your score more than you realize. There's also new credit inquiries, about 10% of your score. Every time you apply for new credit, like a credit card or car loan, your score can drop a few points because of a hard inquiry. One or two inquiries aren't a big deal, but multiple new applications in a short period can spook lenders. The good news is that when you're shopping for a mortgage or auto loan within a short time frame, up to 45 days, those inquiries often get grouped together as one, so it doesn't hurt you or ding your score multiple times. Then there's credit mix, about another 10% of your credit score. Lenders want to see that you can handle different types of credit responsibly. Credit cards, installment loans, mortgages, etc. This factor isn't huge, but every little bit helps when you're trying to reach that top tier of scores. Have you ever checked your credit score and wondered, where did I lose 50 points? Usually it's lurking in these 5 categories. And spoiler alert, missed payments and high balances top the usual suspects list. FICO score ranges and mortgage implications. Let's break down the typical FICO range and what they can mean for your mortgage. Now, 300 to 579 is considered poor. Likely you'll have trouble finding a mortgage without a cosigner or larger down payment, although some FHA lenders can accept scores as low as 500 with about 10% down or more, but it's not easy. Expect higher rates and stricter conditions. 580 to 619, we call that below average, and you might get an FHA loan with just 3.5% down. But if your 580 plus score, however, your interest rate will be higher and you'll pay mortgage insurance premiums for the life of the loan with the FHA unless you refinance that later. Now, 620 to 679. Fair to good. This opens more doors, including some conventional loans with 620 plus. Rates are still not the best, but you've got more options. And then 680 to 739, good to very good. Now you're in the zone where conventional loan rates start getting competitive. Lenders look more favorably on you, and you can typically secure better terms. Finally, 740 to 799, excellent. This is typically where you get the prime rates. You may avoid extra fees or interest, high interest altogether. You can usually shop around with confidence. Now, 800 plus, exceptional. You're a credit rock star. Lenders will likely roll out the red carpet, but you really don't get anything different than excellent scores. You'll snag top tier interest rates and can potentially negotiate even better terms. Kind of. But here's a shocker. If your credit score is 800, you're in the top 20% of American consumers. Ready to join the credit elite? Well, let's start talking strategy now. Let's make this concrete. Suppose you're looking at a $300,000 30-year fixed mortgage, just for an easy example. Check out how different credit scores might affect your interest rate and monthly payment. So at a FICO 760 plus, maybe you qualify for a 5% rate around 5.125 APR, example only, monthly payment around $1,610, principal and interest. At FICO 680, you might see something closer to 5.5% with an APR of 5.7 with a monthly payment of $1,703. Now FICO 620, now you might be looking at 6.25 to 6.5 APR and a monthly payment at $1,847. Over 30 years, that difference of roughly 1.25% between the top tier, the borderline qualifying, could cost you tens of thousands in extra interest over 30 years. That's money you could have used for renovations, a vacation, or maybe just, breathing room in your monthly budget. Always remember this, rates fluctuate constantly, and actual numbers will vary based on market conditions. These examples are completely hypothetical, but they do illustrate the point. There are myths and misunderstandings when it comes to credit. Myth number 1, checking your own credit hurts your score. And the reality is this, viewing your own credit report and score results in a soft inquiry, which does not negatively affect your FICO score. Feel free to keep an eye on your credit health. Myth number 2. A divorce decree changes responsibility for joint accounts. All right. The reality is this. The credit bureaus don't care about your divorce decree. If your name is on the account, you're still responsible for any and all missed payments, which can tank your score. Myth number 3. Carrying a small balance increases your score. Okay, reality. It's true that you don't want to close all accounts and never use credit at all. But carrying a balance on purpose isn't typically going to boost your score. If you use your credit card regularly, then pay it off, or at least down to a very low balance each month, that's enough to show activity and build credit history without paying interest. Myth number 4, you only have one FICO score. All right, no. Reality is you actually have multiple FICO scores, each potentially varying slightly depending on the bureau and the specific scoring model. Lenders can pull from any or all of them. Now that we've busted some myths, let's talk about the million-dollar question. How do you raise that FICO score ASAP and lock in a better mortgage deal? How to increase your FICO score before applying for a mortgage? Number 1, pay down the balances. Focus on high interest, high balance credit cards first. Reduce your credit utilization from, say, 50% or higher down to 20%. That can lead to a quick score bump. Then check for errors on your credit reports. You'd be surprised how often people have negative marks on their reports that aren't even theirs, like a collection account from someone with a very similar name. Dispute any inaccuracies with the credit bureaus. If the error is removed, you could see a jump in your score in as little as 30 days. Number 3, bring delinquent accounts current. If you have any late payments or accounts in collections, consider negotiating a payment plan or a settlement. Some creditors will remove negative marks once you've paid in full. Number 4, avoid opening or closing accounts right before a mortgage application. A flurry of new credit inquiries can temporarily drop your score. Closing old accounts can also shorten your credit history and increase your utilization on the remaining cards. Number 5, set up automatic payments or reminders. Look, a payment history is 35% of your score. One missed payment can derail your progress, so automation can be a lifesaver. Number 6, use a secured credit card if needed. If you're rebuilding from a low score or bankruptcy, something like that, a secured card, that's where you put down cash deposit on the card. It can help you demonstrate responsible credit usage, and over time, this builds a positive payment record. Number 7, do not max out a single card. Even if your overall utilization is acceptable, maxing out one card can raise red flags. Try to spread the balances across multiple cards. Ideally, keep each card's usage as low as possible. How long does it take to see results in your FICO change? Well, credit building isn't a one and done chore. It's more like a marathon. Generally, significant credit changes can take a few months to a year, depending on how serious the issues are. However, some quick wins might appear in as little as 30 to 60 days, especially if you pay down a big chunk of your balances, successfully dispute erroneous negative items, remove old incorrect collection accounts, or even late payments. If you know you'll be shopping for a home in the next 6 to 12 months, starting cleaning up your credit today is the best idea. A slight jump in your score could qualify you for better mortgage terms, which can save you thousands over the life of the loan. Ever hear the phrase, time is money?
Time is money.
In credit land, time is a lot of money, especially when you're shaving interest points off of a 30-year mortgage. Here's some special considerations for mortgage shoppers. Mortgage credit pulls. When you're actively shopping for a mortgage, FICO counts all inquiries within a shopping window, typically up to 45 days, as one check. So don't be afraid to compare multiple lenders. You won't get penalized for each separate check if it's within that window. There is such a thing as a rapid rescore. If you're in the process of applying for a mortgage and find an error on your report, or you can quickly pay down a large chunk of debt, Some lenders can offer a rapid rescore service. This can update your credit file with just new info in just a couple days, which might give you your score an immediate boost. There's joint applications. If you're applying with a partner, most mortgage lenders will look at both your credit scores, but use the lower middle score for underwriting. If one of you has a significantly lower score, it might be worth focusing on improving that person's credit or applying solo if you qualify on your own. And that's, if it's allowed by your financial institution. Okay, FICO scores versus debt to income ratios. While you're focusing on FICO scores today, remember that lenders also look at your debt to income ratio, the percentage of your monthly income that goes toward debt payments. Even if you have an 800 plus FICO score, a high DTI can limit your loan options or the amount you can borrow. Ideally, you want your total monthly debts, including the new mortgage, to be no more than about 43 to 45% of your gross monthly income, though some programs do allow us to go higher. Here's some final thoughts, and I promise it's all connected. It's all connected. At the end of the day, your FICO score is a reflection of how responsibly you handle credit. It's not designed to be a moral judgment. It's simply a statistical tool. But in practical terms, it can mean the difference between securing a comfortable mortgage that lets you sleep at night or scrambling to make ends meet under a high-interest loan. The great news? A FICO score can be improved over time with consistent, deliberate actions, paying down balances, paying on time, checking for errors. You can steadily climb into a higher score bracket and unlock better mortgage deals. Remember, you are not stuck with your current FICO score. With the right plan, you can boost that number and save yourself a heap of cash. It's like giving yourself a raise without ever changing your job. Thanks so much for sticking with me through this deep dive into FICO scores and how they impact your mortgage. Whether you're a first-time homebuyer, refinancing for the third time, or just credit curious, knowledge is power. And in this case, it's money. By understanding how FICO scores work and taking steps to improve yours, you set yourself up for success when you finally sit down at the closing table. If you still have questions about your specific credit situation or how it might affect your mortgage options, don't be shy. Leave a comment, reach out to a trusted lender, or consult a credit counseling service for personalized guidance. Until next time, happy house hunting, and remember, a better FICO score is right around the corner if you put in the effort today. My name is Nathan Nottingham with Be My Neighbor Mortgage, NMLS 270165. I appreciate you listening.